If I was guessing, I would guess that many of you have access to or could invest into an HSA or health savings account. However, of the people who contribute, 90% or more of you probably don't use the account to its fullest potential. Today, we're going to break down an HSA strategy that could help you save thousands over your lifetime. I'm your host, Eli Freeman, a certified financial planner, and this is Data Brief, where we break down the data behind investing so that you can make better decisions based on facts and not feelings. As always, let's look at the data. An HSA is the most tax-advantaged account. That's right, you heard it, the most tax-advantaged account, and it often is referred to as triple tax-advantaged. Your contributions go into the account as pre-tax contributions, the monies grow tax-free, and withdrawals are tax-free when you use it for qualified medical expense. Other accounts don't receive all three of those benefits, typically only receiving one or two. To be eligible for that triple tax advantage, you must meet three criterion. You must be enrolled in a high deductible health plan, you cannot be enrolled in Medicare, and you cannot be claimed as a dependent on someone else's tax return. If you meet those requirements, you can contribute to an HSA. Contribution limits are adjusted annually for inflation and differ between individual and family coverage, with an additional catch-up contribution available once you reach the age of 55. I recommend you just Google your situation. Unlike an FSA or flexible spending account, the money does not expire. It rolls forward every single year. Also, how you contribute to your HSA matters. If your contributions are made through your payroll deductions, they actually avoid federal income tax or FICA tax, which is your Social Security and Medicare tax. However, if you contribute on your own, you still receive a federal income tax deduction, but you do not avoid paying FICA taxes. So when possible, if you can, contribute through your payroll deductions so that you can optimize by minimizing your FICA taxes. So most people treat an HSA like a checking account. They use it to pay for medical expenses as they come up. But that approach misses what I would consider the biggest opportunity of an HSA. If you have the cash flow, a more optimal strategy is to max out your HSA each year, but pay for your medical expenses out of your pocket or your regular bank account. That way, you can invest the HSA and allow the HSA to continue to grow tax-free. The reason that you do this is because every qualified medical expense can be reimbursed at a later date, as long as the expense occurred after the HSA was established and you kept the receipt. There is no deadline for reimbursement, so what this creates is a future tax-free pool of money. You allow the account to compound tax-free over time, and later, in retirement, you can reimburse yourself for those past expenses and withdraw the money completely tax-free. Now, there was a very important step in what I just said, and I want to make sure that you do not miss it. Once you contribute to the HSA, you have to take the next step and actually invest the cash in the account. If you don't, then you don't receive the tax-free growth. You only receive 2 of the 3 tax benefits, and your account doesn't grow while it sits there. So here's a quick example. Suppose you contribute the maximum to your HSA every year for 20 years, and you invest it instead of spending it. You pay your medical expenses out of pocket during that time, and you save every receipt. Well, by retirement, you now have a large invested HSA balance that can be used to reimburse those accumulated expenses tax-free. At the same time, you've effectively created a second tax-free retirement bucket on top of your Roth accounts. This could be 6 figures large by the time of your retirement. And this becomes a big deal because Fidelity just released a report in 2025 saying that the average retiree at the age of 65 will spend $172,500 in healthcare and medical expenses throughout retirement. So having a bucket that is set aside for the purpose of those medical expenses will be very important for almost every retiree. Now, who is this strategy for, or who does it work best for? It tends to work best for individuals or families who have strong cash flow or income and can afford to pay current medical expenses out of pocket without stress. It's especially powerful for high income earners looking for additional tax advantage space beyond 401ks and IRAs. On the flip side, it's generally not ideal for households where cash flow is tight, where medical expenses are frequent and needed for day-to-day budgeting. Those individuals may be better off not even having a high deductible health plan because of the higher out-of-pocket costs from year to year. There's no need to have an HSA if you lose all of the benefits year after year by paying more in medical costs. It's very important to weigh the differences in plan coverage from your employer for your specific medical circumstances. One other thing to know. after the age of 65, the HSA actually becomes even more flexible. If funds are used for non-medical expenses, there is no penalty, but withdrawals are taxed as ordinary income, which is basically just a traditional IRA. So even in a non-ideal scenario, the account still functions as a pre-tax retirement vehicle. The goal isn't just to use an HSA for today's healthcare costs, but to maximize its long-term value as a planning tool. Because when used correctly, it can provide tax-free income in retirement, reduce your lifetime tax burden, and increase your flexibility when you need it the most. If you enjoyed this video, I have another video on how to optimize your healthcare if you are retiring before the age of 65, and I will link it here.